Hey everyone, and welcome back to the Babalian Money Show. Let's be honest, things feel a little crazy right now. Inflation is still stubbornly high, geopolitical tensions are simmering, and the word recession is on everyone's lips. If you're looking at your investment portfolio, your gut instinct might be screaming at you to sell everything and hide the cash under your bed. I get it, that fear is real. But what if I told you that this feeling, this uncertainty, isn't a bug in the system? It's a feature. It's a permanent part of how markets work. And the investors who understand this are the ones who come out ahead. So today, we're not going to panic. We're going to open the playbook for investing during market uncertainty. First, let's talk about why our brains are just not wired for this kind of chaos. There's a powerful psychological principle called loss aversion. Researchers have found that the pain we feel from losing $100 is roughly twice as powerful as the pleasure we get from gaining $100. When the market drops, our ancient fight-or-flight brain kicks in. It sees a threat and tells us to run for safety, to sell before things get worse. But here is the paradox of investing. The market's best days often happen right after its worst days. Historical data shows that if you panic sell after a major downturn, you're almost guaranteed to miss the powerful rebound that follows. By trying to avoid the pain of further losses, you lock in your losses and miss out on the recovery. The people who get wiped out aren't the ones who hold through the storm. They're the ones who sell at the bottom. So, if timing the market is a loser's game, what's the winning strategy? It's a beautifully simple and powerful tool, and it's my ultimate weapon against uncertainty. Dollar cost averaging, or DCA. It sounds technical, but the concept is easy. Instead of trying to guess the perfect time to invest a lump sum of money, you invest a fixed amount on a regular schedule, say $500 on the first of every month, no matter what the headlines are screaming. When the market is down and prices are low, your fixed amount buys you more shares. Think of it as your favorite stocks being on sale. When the market is up and prices are high, that same amount buys you fewer shares. Over time, this strategy automatically forces you to buy low and smooths out your average purchase price. It removes emotion and the impossible task of predicting the future. You just set it, forget it, and let the system work for you through all market cycles. Now, DCA is your offensive strategy, but in uncertain times, you also need a strong defense. This brings us to the safety net, diversification. The very definition of uncertainty is that you don't know what's going to go wrong next. Will it be tech stocks? A specific country's economy? A new crypto project? We don't know. And because we don't know, it's incredibly risky to bet your entire future on one single stock or asset class. Diversification is about spreading your risk so that one single failure doesn't sink your entire financial ship. This means owning a mix of assets. For most people, a great starting point is a broad market index fund or ETF, like one that tracks the S&P 500. This instantly gives you a tiny piece of 500 of the largest U.S. companies. From there, you might add some bonds or hold a bit more cash for stability, which acts as a cushion during downturns. The goal isn't to pick the one winner. It is to build a resilient portfolio that can weather any storm because it is not overly exposed to any single point of failure. Finally, I want to talk about your media diet. 24-hour financial news networks and social media feeds are not designed to make you a better investor. They are designed to sell advertising. And you know what sells ads? Fear, panic, and drama. They profit from your anxiety. Constantly checking your portfolio and consuming a non-stop stream of breaking news about the market will only amplify your fear and tempt you to make emotional, short-sighted decisions. During periods of high uncertainty, one of the most profitable actions you can take is often inaction. Stop checking your portfolio every hour. Turn off the notifications. Step away from the noise and trust the long-term plan you've put in place. So let's bring it all together. Uncertainty is normal. Your fear is understandable, but acting on it is a mistake. Instead, we use a playbook. We use dollar cost averaging to consistently invest, We build a diversified portfolio to protect ourselves from the unknown, and we tune out the short-term noise that's designed to make us panic. Remember this, fortunes are not made in bull markets. They are simply collected then. Fortunes are built in bear markets, during times of fear and uncertainty, by those who have the discipline to stay the course. Thank you for tuning in to the Babalian Money Show. If you want more rational, no-nonsense advice for navigating these crazy markets, make sure you hit that subscribe button. We'll see you in the next video.